G'day everyone, welcome back to Pete's Investing. Today we're putting out a little video in terms of tracking a share price and knowing when to initially buy, when to sell at a target price, and when to average down and how many you should buy when you're averaging down. So before we get into that, don't forget to review the playlists on my channel. That's where we review the weekly updates of the indices we look at, some blue chip shares we look at each week, and also the strategy playlist, which shows the simple trading strategy, the average down process, how that works, and some money management ideas. So let's get stuck straight into it. I'm not going to go through any charts as such. I'm simply going to show you this spreadsheet and how to use it when you're tracking your share prices. So first off, I've got instructions here, and I'll go through the instructions with you slowly as we go through a couple of examples. So here I've got some sample, if you like, test dummy share prices when the initial open of those share prices were bought, when they were initially bought, how many we bought, the price we bought them at, and this just tracks what we on a daily basis what the current share price is. So let's go through the instructions one by one. The light green cells we update once only. So when we buy those shares, we update these light green cells here. On a daily basis, we update the orange cells here. I'll talk about the watch list in a minute and the close one. So the light green and the orange, what we update here, we show the brokerage. So here we're saying we've bought one lot of 6 shares for AAA there, and so one set of initial trade entries, and that brokerage amount, that's a quantity of brokerage. The brokerage amount in this case is $10 to buy. So we bought $2,000 worth, and that's where we put on the orange up there. We say we're going to invest $2,000 in each of these examples. So we bought $2,000 worth at $231. We bought 6 shares at $231 per share. And this now shows, so assuming we bought that back a couple of months ago, and it's assuming the share price has dropped from $231 down to $150, this is showing our current profit and loss. And this just shows you some indicative percentage losses as well, and the book cost, etc., etc. I'll talk about what these are in a minute. So we do that, and we track these particular shares on a daily basis. We update these orange cells only. Now, so the other thing too is with the target, this is also our target price. So what we're saying is we want to increase our profits by at least 5% growth in each of these. What this means is we put our target up there. You don't want to make it too small, but you don't want to make it too big either. If you make it too small, you might exit at a minimal profit. And at the same time, if you make it too big, you may be in the market for a while before you realize any gains, albeit they'll be good gains. But if the share price doesn't actually rise to your expectations, then you might be in the market longer than you expect. So 5% is a good return for any share price increase. In terms of the green, this dark green, this is a calculated cell. It'll turn green if the profit target has been reached. In this example, we said we want to reach 5% profit growth, and so in this case, we bought initially at 270. We bought 722 shares at 277 per share for company HHH, and the current price is 292, and that's saying there minimum profit has been reached based on 5%. So a couple of things can change here. Let me change this up here. If we change that, say, to 3%, you'll see there that Triple G was also just indicated there as a potential sell. You'll make a 1% gain. There's another one there for Triple D, has also reached its target price. Same time, if you make that, we made it initially 5%, so let's make that 10%. You'll see there that no targets have been reached. So again, you want to make it a reasonable profit return. So 5% in this case will yield us $88 for Triple H and $91.98 for Triple I. These costs also, these profit losses also factor in the brokerage. So what it's doing here, assuming we sold Triple H at the current price of $292, we would gain $88.30, and that also factors in brokerage. So we've already bought one initially when we bought the one lot of 722, but it's also on the right side of this spreadsheet. It also factors in another close brokerage cost of $10. So that's already factored in $20 of brokerage. So in other words, had we not factored in the brokerage, that would have been $108. But because we're factoring in the brokerage, we're taking $20 off the profits. That's how. So that's already factoring in brokerage. So then we look at we looked at the brokerage per trade. We talked about that. We update the orange cells on a daily basis. So again, we update these on a daily basis, and we update these on initial entry. Now, going back to this one, which shows the AAA, which shows the average down process of -32. So we're putting in a -30 as our cutoff point. So anything that falls below -30 is a potential to buy more stock, more shares to average down. Now, I want to emphasize a couple of things here. This goes through the average down example in a bit more detail. So what it's saying here is our initial purchase of 6 shares at $231, so we're down at $509. What it's saying here is we've reached our 30% negative cutoff point, and the new average down price will be $175. So now it's saying you can buy an additional 13 shares. Remember, 13 shares of $2,000 value. You can buy 13 shares. So what that means is we would buy an additional 13 shares, so 6 plus 13, that will be 19. And the average between that and that would be averaged down to, or it would have been actually, make the 6. The new average price will be 175. So that'll be then 19 and 175.33 over here. Right. So now what it's saying is we bought our additional 13 shares, and this is now recalculated, saying it's now -6% from our initial entry. So we're down by $501, but our average price is now 175 instead of what it was previously. Hope that helps explain that. The others are not yet qualified for an average down. These ones are qualifying for to close the trade if you wish. So let's just back that out to where it was. That was 231.61, and that was 6 shares. So that's how you average down. Down here is a watch of a particular share. So let's say we're looking at buying Triple J. We're interested in that company. We want to buy $2,000. Again, don't forget this can be changed at any time, and that'll change for all these. So if we made that say $3,000, that changes for all that, and that recalculates all these other values. Let's keep it at $2,000 to be consistent with our charting videos we produce. We're buying $2,000 lots. That's saying if the current price of Triple J is $509, you need to buy 393 shares for the value of $2,000. Then once you've done that, you would simply copy one of these lines and paste it down there. That would now become Triple J. Today's date, let's say it's 11th of July, 21. And we bought 393 at 509. And let's assuming the current price is 509 as well, to be consistent. So that's assuming that was the purchase today. We bought 393 at 509. So we're down $20, and don't forget that $20 is your entry and exit for brokerage factored in. So then from tomorrow, let's just say tomorrow the share price of that was 513. That automatically adjusts the profit and loss, and it goes forward and does all the other calculations which you don't need to worry about. Again, you wouldn't buy any of these to average down because they haven't met that -30 criteria. Now going back to my instructions, I put in a caution here. The 30% figure was back tested and shown to be the most effective. To use a higher figure, example 70%, may not result in an effective average down time frame to be met. That is, you might be in the market longer than you expected. Alternatively, to put in a low figure, example 10% decline, may result in too many shares being invested, using up all your capital. So you don't want to buy when the market's going sideways. You want to buy when the share prices drop significantly, and 30% is a significant amount before purchasing anything. And don't forget the trading strategy we use is the share price must drop around 30%, but also our CCI indicator must break above 0, which is in our trading strategy video from the playlist if you refer to that. That's pretty much it. Now, in terms of closing a trade, So that's assuming we just bought Triple J there. Let's assuming we were to close out Triple I. That's assuming we wanted to sell that at 58.66 today. You would copy that and you go into the close column and you paste it in there. You put in today's date, which was 11th of July. So it's saying we should make approximately 91.98. Well, you should make 91.98, including brokerage. The rest of the cells just leave as is. It's just copy and paste, so we don't have to worry about stuffing around too much with different fields. All you need to worry about is copying and pasting from the open to the closed tab. And you would obviously delete that. You would delete that row, and that'd be your new holding. So from now on, from tomorrow onwards, you'd be updating those values in the orange cells. Okay, that's pretty much it. I'll put in some instructions there. Hopefully that's helped. I'll attach this template to the video in the comment section, and feel free to subscribe, like, and click on the notification bell to get further updates as they become available. Okay, and I'll speak to you guys in the next video. Thanks for watching.